Good morning, friends. Let me tell you a story of two businessmen and their families, Mr. Cautious and Mr. Casual. Both are in the same line of business. In scale of business, also, they are similar. The family size is almost alike, a wife and a child. Businessmen, for the purpose of expansion, need money. Sometimes they bring in this money by way of equities, and sometimes, or probably many times, they bring in this money through loans or debts. So, Mr. Cautious and Mr. Casual, when they had an opportunity to expand the business and they needed money, so they went to the bank and asked for a loan. When they asked for a loan, the bank, after going through their project reports, was willing to sanction the loan, but to securitize the loan, they wanted a property to be mortgaged. So both Mr. Cautious and Mr. Casual, they mortgaged their family assets, the house, and probably other assets which are mortgageable, to the bank, and the bank gave them loan. Using this loan, both of them put in this money to expand their business. Now, the bank gave the loan to these two people. In turn, they securitized the loan by a property mortgage. Now, how are these two people going to securitize this loan? Meaning, release from this loan. Mr. Cautious thought about this, and at the time of mortgaging his family assets, he also purchased a life insurance policy and gave it as a collateral security to the bank. By doing this, Mr. Cautious spent the risk premium, the premium that is used to cover the risk of death. Whereas Mr. Casual, he decided not to go in for the life insurance because it's going to be an extra premium burden or the expenditure to himself or to his company. So he decided not to do a life insurance policy. While Mr. Cautious spent the risk premium, Mr. Casual saved the risk premium. Both of them, with good intentions, worked hard, and gradually, from their profits, they started repaying the loan. But unfortunately, before the term of the loan got over, they died. What happened upon their death? In case of Mr. Cautious, the life insurance policy, which was given as collateral security, released the money upon his death to the bank. And now the bank got the balance money due to them, so they released the family assets in favor of Mrs. Cautious and their child. Mr. Cautious spent the risk premium, but he saved his family assets. In case of Mr. Casual, after his death, the bank attached the property, the mortgaged assets, tried to auction it to recover the balance loan, and after recovering the balance loan, still some more amount was left due to them, so which became a burden on Mrs. Casual and her child. Mr. Casual saved the premium, but he spent his family assets. When an asset is auctioned against a distressed situation, the auction may not purchase the correct value of the asset. Most of the times, it may get undervalued money. Mr. Cautious spent the risk premium but saved his family assets. Mr. Casual saved the risk premium but he spent his family assets. Not only in terms of businessmen, even in terms of individuals, protecting the liability through a life insurance policy so that the liabilities do not become a burden on the family is an approach which people like Mr. Cautious would like to do. Now let me show a small calculation on how people protect the liabilities that it does not become a burden on their family members. So let's prepare a table. Debts on one side, amount of debts, and divided by monthly income. How many times the monthly income could be the outstanding as on date? The rate of interest and the interest amount. Let's take an example of a person earning 2 lakhs per month. His housing loan outstanding is 1 crore. Divided by 2 lakhs, it is 50 times the monthly income. The rate of interest at which the borrowing was availed was 10%. That means yearly interest outgo is 10 lakhs. The vehicle loans, 20 lakhs outstanding, divided by 2, 10 times. Rate of interest 8%, 1 lakh 60,000 interest amount per annum. Business loans outstanding in this case 50 lakhs divided by monthly income 2 lakhs 25 times. Rate of interest 12%, interest outgo is 6 lakhs. Education loan for the child 20 lakhs outstanding divided by 2 lakhs 10 times, 9% rate of interest, interest amount 1 lakh 80,000. Personal and appliances loan. People buy washing machines, mobile phones, fast moving consumer goods on credit. In this case, it's nil, so we leave the row blank. Credit cards, outstandings. In this case, nil, so we leave it blank. Many times people ignore this liability on themselves. If somebody has signed guarantor form for some other purposes, for other person's loan, then in case of default, it can become a burden on the person who has guaranteed the amount. People stand sureties for others' loan. In this particular case under discussion, 50 lakhs is the amount guaranteed, is the signature worth of 50 lakhs rupees for another person. Divided by 2 lakhs, it's 25 times. In all, in this particular case under discussion, 2.4 crores outstanding. It's 120 months. Now, this amount of loan is equal to 120 months of income. It's too long a period for anybody to take risk. It's not 1 month. Even 1 month is not a risk to be taken. But sometimes it is justified. People say that what can happen, what can go wrong in 1 month time. But 120 months, a huge period, it's a big period. An easier method to cover this would be taking a life insurance policy of 2.4 crores. On an average, the risk premium works out to 0.85% in our country. The weighted average already of the interest paid by this person is 10.58%. Assuming the interest rates have moved up by 0.85%, the person would still have continued availing this loan. So, by taking a 2.5 crores policy, which can demand a 0.85% as the risk premium, it's not a big expense. But then this expense can probably protect the family. In case the person to whom the bank has lent money is no more, then the banks and the financial institutions would like to see that their loans are repaid by way of sale of assets, mortgaged, pledged. Now, this policy of 2.5 crores can quickly release those assets favoring the family. In short, risk ignorance is not risk management. We've just started a series of stories of Mr. Casual and Mr. Cautious. This is the first episode. The second episode will be focusing on how much a person need to control his expenses and how much savings will be adequate in case there is a dip in the business income. See you in the next episode. Thank you for joining us.